Hello everybody. Welcome to BCS initiative of Tax Gurukul. We are thankful to BCS for ensuring that while we are physically distant, we remain socially connected and at least our learnings are not that distant. Hi, I am Priyanka Jain and today we are going to talk about the various amendments which have been incorporated in the Finance Act of 2021. To start with, on the day this budget was being introduced in the parliament, we had not envisaged that by the time it would be enacted, we would be pushing ourselves into almost another lockdown. Having said that, I wish that you and your family are keeping safe and well in these unprecedented times. And I speak on behalf of everybody and we acknowledge all the efforts of the men and women who work day and night to provide us with the medical facilities and the basic needs of our day-to-day living. Um, while the finance bill was introduced in the parliament on the 1st Feb 21, it changed its tenor by the time it was passed on March 21. Uh, Generally, the amendments which happen during these intervening period are clarificatory or curative in nature, or they are intended to rectify certain anomalies in the finance bills. The other kind of amendments are where altogether the provisions which had been proposed are dropped based on the representations of the stakeholders. However, we have seen a recent trend where significant amendments are being introduced for the first time in the Finance Act itself, and probably that's how the money bill is being passed by the Lok Sabha, maybe without too much of deliberations and discussion. One of the very significant amendments which found its way in this year's Finance Act 2021 is regarding slum sale, which is going to have a far-reaching impact on the various reorganization and corporate restructuring in today's time. Uh, Slum sale is defined to mean transfer of one or more undertakings for a lump sum consideration without values being assigned to individual assets or liabilities. The computation mechanism provides that the net worth of the undertaking shall be reduced from the actual sale consideration, and the difference shall be offered for tax under the head capital gain. Now, there was certain amendment was already proposed in Finance Bill of 2021. Uh, Various courts and tribunals had held that transfer of an undertaking other than by way of a cash sale is not technically a slump sale and hence will not fall within the ambit of the provisions of capital gains. With an intent to nullify these rulings, the Finance Bill 2021 proposed to amend the definition of slump sale to include with its ambit transfers by all modes, namely exchanges, relinquishment, extinguishment of any rights, etc. While the amendment, which was uh, further done in the Finance Bill 2021, went a step further and provided that in case where the transfer of an undertaking happens for a lump sum consideration, the fair market value of the undertaking shall be deemed to be the full value of the consideration arising or accruing as a result of the transfer of such capital asset. Consequent to this amendment, the fair market value will be deemed to be the sale consideration, and where the actual sale consideration is higher than the fair market value, the reading of the provision implies that maybe the taxpayer can opt for the beneficial provision and substitute the lower fair market value to offer a lower capital gains income to tax. While the more clarity would be brought in when the valuation mechanisms are prescribed in due course, in the hands of the seller, where the actual consideration is less than the fair market value, then of course the fair market value will be deemed to be the field consideration, and he'll have to offer a higher capital gains tax. The implications in hands of the buyer is that where the actual consideration is more than the fair market value, then the excess will be recognized as goodwill in its books. However, the Finance Bill 21 has sought to prohibit the depreciation on such goodwill. If the actual consideration is less than the fair market value, the difference shall be treated as capital reserve, not chargeable to tax. Now we have seen that as latest as in 2020, various large corporate houses do undertake slum sale at book values, maybe not with an intention to evade taxes, but it is seen as a more tax efficient exercise to consolidate their business operations where mergers or demergers are ruled out. However, we'll have to now deal with these provisions and come back to the drawing board to understand how to achieve tax neutrality where otherwise there are no exemptions or benefits provided under the Income Tax Act. The other significant amendment which had been made in the Finance Bill of 21 was introduction of the definition of the term liable to tax. This provision did not exist before the budget of 21, and the Finance Bill defined the term liable to tax as liable to tax in relation to a person would mean that there is a liability of tax on such person under any law for the time being in force in any country, and shall include a case where subsequent to imposition of tax liability an exemption has been provided. Now, to bring greater clarity, the amendment passed by the Lok Sabha seeks to narrow down the scope of the expression liable to tax, and it provides that the condition of liable to tax is now to be seen in relation to a person and with reference to a country as opposed to liability of tax of the person in any country. Secondly, the liability of tax was to be examined in respect of any law for the time being in force. The amendment by the Lok Sabha now restricts the same to income tax liability under the law of the other country. This amendment again seeks to nullify the decision of the Bombay High Court, wherein a partnership firm established in Germany was liable to trade tax but not income tax, and it was held by the Honorable High Court that it is liable to tax in Germany for the purposes of provisions of Article 4 of the India-Germany Tax Treaty, since trade tax is also one of the taxes covered under Article 2 of the said treaty. In other words, now the person having income tax liability under the laws of that country and who have been subsequently exempted from taxation would only be deemed to be a person liable to tax. Therefore, persons of Indian origin staying in countries where no income tax laws for taxation of personal income tax exist, they will be governed by the residence rules of the Income Tax Act. However, in cases of UAE and Saudi Arabia, there is a specific language of the treaty with India, wherein the individual staying for more than 183 days would qualify as residents as those countries, as opposed to the term liable to tax in that state. And hence, even though the amendment has been brought in the Domestic Act, the treaty benefits would continue to apply, and the persons residing in these countries may not qualify as residents in India. The third amendment is regarding the taxation of interest earned and the exemptions provided on the accumulated balance of provident funds. Now, Section 10(11) and Section 10(12) of the Income Tax Act provide that any payments received by a taxpayer from a provident fund or public provident fund, as also the accumulated balance due and becoming payable to an employee from a recognized provident fund, shall be exempt from tax. The Finance Bill of 2021, with an intent to tax the income earned by persons or employees who contribute large sums to such funds and then claim exemptions, proposed to introduce a cap on the maximum yearly contribution, and income arising thereon was to be considered as exempt by way of introduction of proviso in the said section. It provided that exemption shall not be available on interest accrued in the account of a person during the previous year, to the extent it relates to the amount or aggregated amount contributed by such person which exceeded 2.5 lakhs in that previous year in that fund. The finance bill got further amended by introduction of a second proviso in section 1011 and 1012 to enhance the tax-free limit of contribution in the said fund from 2.5 lakhs to 5 lakhs, subject to the condition that there shall not be any contribution by the employer of that person in goodwill is recognized as a commercial right which is eligible for depreciation under Section 32 as per the judgment of the Honorable Supreme Court in case of Smith Securities. Accordingly, the cost of goodwill acquired is also included as part of block of assets for claiming depreciation thereon. While the Finance Bill of 2021, with an intent to deny the depreciation on goodwill, proposed to amend Section 211 and Section 32 to specifically exclude goodwill of a business or profession from the definition of block of assets so that depreciation can be denied thereon. Accordingly, depreciation is not allowable on goodwill with effect from assessment year 21-22, including for goodwills which had been acquired in the previous year. Section 43(6) of the Act stands amended now so as to delete the value of goodwill if it has already been included in the written down value of block of assets as on 1/4/21. Accordingly, the Finance Bill amended the section to provide that the WDV of intangible assets as on March 31, 2020 shall be adjusted by reducing the standalone WDV of the goodwill computed as the difference between the actual cost of goodwill and the depreciation allowable on such goodwill until 31st March 2020. The reduction, however, shall not exceed the closing WDV of such intangible assets as on 31st March 20. The Finance Bill amends the Section 211 and 32 to specifically exclude goodwill from business or profession. Also, 43(6) now stands amended to remove the value of goodwill from the written down value of the block of assets. As a result, pursuant to all of these amendments, depreciation on goodwill that has been capitalized and has formed part of block of assets has been withdrawn retroactively with effect from 2021. As we have seen that the state does have power to make retrospective amendments to the tax laws, and such a tax may particularly be necessary maybe to curb any malpractices. However, the said amendment regarding goodwill, which has been brought by the Finance Act of 21, it results in denial of depreciation acquired on goodwill in the past and which is already part of the block of assets. It essentially takes away the rights which had already vested in the assessee. There has been decisions of the court to effect that once depreciation on an asset has been allowed in the initial year, the same cannot be questioned in the subsequent years. Probably we have to wait and watch to see whether this amendment particularly would be challenged before the court by way of a writ petition and any relief can be sought. There has been a new insertion of Section 9 capital T, and to understand the context, let's rewind back to Section 45(4), which provides that capital gains tax shall be imposed in the hands of the firm where the capital asset of the firm is distributed to the partner on dissolution or otherwise. Finance Bill 2021 proposed to substitute this existing section and also insert a new subsection 4A to section 45. Uh, the intent was to provide that where a partner of the firm received during the previous year any capital asset as a result of dissolution or reconstitution and which represents his or her capital balance at that time, then the profit, which is equal to the fair market value of the capital asset minus cost of acquisition arising from receipt of such capital asset by the partner shall be taxed in the hands of the firm in the year in which such capital asset is received by the partner. Further, the balance in capital account was to be calculated without taking into account any increase in value due to revaluation of an asset. Now, this provisions proposed a lot of issues on their interpretation and practical application. With a view to simplify the scheme of taxation, a new scheme of taxation has been introduced for the partnership taxation. Section Capital 9B has been inserted by the Finance Bill as amended to provide that where partner receives any capital asset or stock in trade or both in connection with the dissolution or reconstitution of the firm, then the firm shall be deemed to have transferred such capital asset or stock in trade in the year in which such assets are received by the partner. B. The transfer shall be charged to tax in the hands of the firm under the head profits and gains of business or profession in case where it's a stock in trade and capital gains where it's a capital asset. The fair market value of the asset on date of receipt shall be deemed to be the full value of consideration of the asset. Even the reconstitution has been defined to mean cases where one or more partners retire, one or more new partners or members are admitted with at least one existing partner continuing in the firm, or there is a change in shares of existing partner. Section 45(4) has been newly substituted to provide that the partner of the firm who is receiving any capital asset or money or both as a result of reconstitution, the term reconstitution has been defined in section 9B as we just saw, then capital gain shall be chargeable to tax in the hands of the firm in the year of receipt by the partner. The calculation mechanism for the capital gain has been prescribed by way of a formula. The earlier section 45(4)A, which was proposed by the Finance Bill 21, has now been dropped, and consequential amendment has been made in section 48 to provide that the amount of capital gains offered to tax by the firm under section 45(4) shall subsequently be allowed as a reduction while computing capital gains in the hands of the partner. The amended provisions provide better clarity to the scheme of taxation in case of reconstitution of a firm in relation to the amendments which were originally introduced in the Finance Bill of 2021. While Section 9B covers cases relating to both dissolution and reconstitution, Section 45(4) only provides mechanism for computing capital gains in case of reconstitution. Now, under the amended provisions, the cost of asset transferred, including its index cost, is not to be considered. The amended provisions taxes the deemed benefits in the hands of the partner as capital gains or business incomes in the hands of the firm. Now, though Section 90 states that income chargeable under the head business income shall be in accordance with the provisions, the computation of business income in case of distribution of stock in trade is not clear. The computation in case of distribution of both stock in trade and capital asset is also not clear. So there is also no rationale or logic in denying the benefit of capital loss under Section 45 Capital 4. Equalization levy was first introduced by Finance Act 2016. Finance Act 2020 extended the scope of equalization levy to cover consideration which are received by e-commerce operators from e-commerce supplier of goods or services. The Finance Bill of 21 proposed to amend Section 165 capital A to provide that consideration received or receivable from e-commerce supply or services shall include consideration for sale of goods or services, irrespective of whether the e-commerce operator owns the goods or provides the services himself or not. The term consideration received or receivable from e-commerce supply or services has now been further amended by the Finance Act 21 to exclude consideration for sale of goods or services which are owned by or provided by a person resident in India or B by a PE in India of a non-resident if sale of such goods or provision of services are effectively connected with such PE. Presently, the e-commerce operators were subjected to levy in respect of gross consideration of goods or sold or services rendered by a person resident in India or Indian fee of a non-resident, but they were already subjected to tax in India. In other words, the consideration from such supply of services or goods was getting taxed twice. This amendment seeks to restrict the applicability of EL provisions to sale of goods or provision of services which are owned or provided by a person located only outside India. Uh, Another amendment has been made is regard to the tax audit provisions in which Section 44A(b) of the Act provides that every person carrying on business uh, and earning a gross receipts exceeding rupees 1 crore and every person carrying on profession with a gross receipts exceeding rupees 50 lakh in a previous year is required to get his or her accounts audited in order to minimize the compliance burden on SMEs. The Finance Act 2020 amended the aforesaid limits uh, by increasing it to rupees 5 crores. However, it was subject to certain conditions. The Finance Bill of 21 increased the threshold further to rupees 10 crores with effect from assessment year 21-22. Uh, the higher threshold of rupees 5 crores and 10 crores applies only if the cash receipt and payment made during the year does not exceed 5% of total receipt and total payment respectively. Now the Finance Act 21 has further amended the section to insert a new proviso to provide that for the computation of threshold of rupees 10 crores, the payments or receipts through account pay check or account pay or non-account pay bank draft shall be deemed to be cash payment or cash receipt respectively. Further, Section 44ADA, which provides for presumptive taxation of a resident assessee carrying on provisions professions referred to in Section 44AA and where the gross receipts do not exceed 50 lakh, allows 50% of the total gross receipts to be offered as the profits and gains of such profession and chargeable to tax. Now, the existing provisions of Section 44ADA were applicable to all resident assessees and there was no prohibitions specifically on companies, LLPs or HUFs. The Finance Bill 21 specifically excluded LLPs from the scope, but the Finance Act 21 further amended this section to exclude HUFs also from the scheme of presumptive taxation. Hence, going forward, the said section will be applicable only to resident individual and partnership firms other than LLPs. There has been further some other relevant amendments which have been incorporated in the Finance Act 21. One of the notable ones being the definition of the term asset, which has been defined under Section 149. So Section 149 was amended to provide that the time limit for issue of reopening notice shall now be 3 years for normal cases and 10 years for cases where AO has in his possession books of accounts or other documents or evidence indicating income escaping assessment represented in the form of asset of rupees 50 lakhs or more. The Finance Act 21 has now defined the term asset to include immovable property, being land or building or both, share securities, loans and advances, deposits in banks accounts.
There has been a few of other amendments which have been made in the Finance Act. Uh, like recomputation of book profits under 115 GB, they have prescribed certain conditions wherein the recomputation would be permissible only if the taxpayer has not utilized the MAT credit in any subsequent year. These amendments would apply from assessment year 2021 and earlier. There has been a change in the fee for delay in filing of return of income and for delay in linking of Aadhaar with PAN. There are various other miscellaneous amendments which we are not deep diving in for the time being in this video. However, the same has been elaborately dealt with in the PPT, and the link to the PPT is attached in the description box below. Hope you found this video useful. In case you have any further doubts or queries, you may get in touch with BCAS at taxgurukul at gmail.com, or you may write to any of the committee members. We appreciate and look forward to your feedback on this video. Thank you, and hope you all stay safe.